Hey there, welcome to the channel. So today I wanted to, first of all, happy Thanksgiving. It is Thanksgiving. Um, I wanted to talk about the yield curve. I was noticing the other day, um, I was looking at this dynamic yield curve tool that they have at Stock Charts, and what it does is on the right, it has the S&P 500, and then on the left it has the yield curve at that time. So we have on the left, we have the yield or the interest rate that you're earning on 3 month, 2 year, 5 year, et cetera, like that. And what I did notice is that here it's like we're kind of just starting to get inverted on the 20 year and 30 year. Normally, a normal type of yield curve would be that you would earn more interest for longer duration and shorter interest for shorter duration. The reason for that is that, if you lend someone money for 30 years, you need to get a higher interest rate. You need to make more money on that to account for the fact that you're losing the use of that money for a longer time. You lend money for 30 years. You need to get a return. And of course, this return is just appallingly crappy. But so what I notice is that, the 20 year and the 30 year, a little bit very flat and almost inverted. They are kind of a little bit inverted. And then also on the 7 year and the 10, they're inverted. And this has been one of the signs that that there's a recession coming. You see this inverted yield curve, and it's been one of these like early indicators of a market correction / crash and a recession. And so I wanted to look at that closely and just try to understand, is that what's maybe going on right now? Now, one of the things is, see, as I back up the chart and time on the right here, see, I'm moving the red line, which is the time, and I'm moving that back, and we can see. And if we go back here, I'm going to go back to 2000. You can see how the yield curve is there. You have this inversion on the 20 and 30, and you have inversion on the 710. And then as we come up to this market peak, see how the entire curve just totally inverts. And then boom, 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 the market comes down, and then we get back to a more normal yield curve, which is something like this, where at the short term, you just have this just increase in the yield as you go up in duration, which is normal. This inversion here is very unnormal because you're basically able to earn the same interest, more interest, lending money for 3 months than you do for 30 years. That obviously makes no sense. And what it means is something's really broken. So we see this again and again. Now here we go again, coming up into this next peak, and we see the same kind of thing. Normal yield curve, market going up, and then suddenly, the curve flattens and then it gets inverted. And in this case, it wasn't a really super duper inversion, but it gets inverted. And next thing you know, the market, bam, crashes. And then we get back to normal yield curve. And now we're in the time that we are now. Now here, you see that since 09, the whole yield curve is kind of like gone down, in terms of it's shifted down to lower rates, which is kind of what we've had. Now here you have a period where it flattens out again, and then we get this, an inversion and nothing much. And it did happen, basically we had the Cerveza sickness shutdown crash, right? And then it got back to maybe a little more normal. And now where we are is we're at this situation where, we have this, it's very, this is not much of an inversion. So really the question is, what's going on here? What's causing the inversion? And so once again, I'm not financial advice. I'm just looking at it, asking the question for myself. So I go over here at chart, and what I did here, gosh, there's a lot of a mess in here. On the bottom, what I have, this is the S&P 500. You can kind of see the chart, it's you had this peak in 2000, another peak in 08, and then here we are now. And then over here on the top, what I'm going to do is I'm charting basically the interest rates over time. So what I'm going to do is I'm going to try to simplify this. There's two things here. The Fed funds rate, so that's this dark blue line here, is what I'm trying to say is the Fed funds rate and the 3-month, this dollar IRX is 3-month, they track each other. So if we look at that, that's the blue and green dotted lines. You look here and they track each other very closely. Blue and green lines right here, they track each other. And then this purple line is the 1-year treasury. So you can see that it kind of tracks, but like here it diverges. The 1-year treasury didn't go as high as the 3-month. So there, right there, you can see that there's a what? An inversion, right? You're getting a higher interest rate. So this is the interest rate on all these. You're getting a higher interest rate at 3-month in the Fed funds rate versus the 1-year. And then the chart here, the candlestick chart, is actually what? That's the 10-year. So that's what this chart is showing. So, but the thing to keep in mind is what I'm really showing here is the Fed funds rate in this blue line and the green line, they track each other. Okay. So basically the short-term rates track what the Fed sets the rates at. They control the Fed funds rate, and the short-term rates affect that. So when you look back at the yield curve and you're like, oh, we're getting some kind of a inversion, what is causing that? What is causing that inversion? Well, it's, if you look here, this period of time, look at the 30-year on the right here is anchored. It's like an anchor. It's not moving much, but what's moving is the short-term rate. So what's happening during that time? Well, what's happening is that the Fed is increasing interest rates. This is their deliberate increasing of interest rates. But at some point, when they start the raising cycle, most likely, given all time and all history, every time that they invert the yield curve, it's caused by the Fed. It's not caused by the market. The market doesn't invert the yield curve. That's just what you see in this data. You know, once again, this is the Fed funds rate. This is a controlled rate, right? They try really hard to control it. They don't always have control. We can debate all that stuff, but they generally control it. So back here, they crank the rates. The economy couldn't handle it. The stock market can't handle it. The stock market, the bond market, they resist in terms of the longer term yield treasuries, like the 10-year, 20-year, 30-year resist. The interest rate and therefore the price doesn't change on those guys. They don't respond to it until some point where, and the Fed keeps raising rates until some point where it's like, oh, gee willikers, you can earn a higher rate of interest lending money for 3 months than for 30 years. And that's what happens. So the point is, coming in the future then, if the Fed goes on now, so now we have to get to speculation. We have all these data samples, you have these data samples. This is going to be a really good thing to look at here. Because something different happened here in this Cerveza thing. And it's different than over here. Like even in the financial crisis back here in 08, 09, they did a lot of bailing out, but they bailed out banks. They didn't bail out people. Okay, it's very important. And so over here, they bailed out people. That's what's causing the inflation. You send money to people, not institutions where it's piled in a pile with all the other money. You give Goldman Sachs $13 billion to cover their loss on AIG insurance bets. That doesn't immediately go, $13 billion doesn't go running into buying fast food. It doesn't go running into the economy buying TVs. It doesn't do that. It just shores up the balance sheet. So it doesn't increase the velocity of money. It doesn't increase the money circulating in the economy. So therefore it has no effect on inflation. Then over here, you sent money to people directly and you get this high inflation, and that's going to force the Fed's hand is what it looks like. And so what I'm trying to say is that all other things being equal, looking at the history, and you can keep going back in history, go back into the 80s, and you kind of see this thing. You see that, hey, the Fed raises rates, the market resists it, the market doesn't respond. And the market here is the overall financial market. So it includes the bond market and then the stock market responding to what's going in the bond market, and it resists it. So all things considered, it's probably going to be the same type of thing. That's what you would expect, right? You expect that the Fed's going to raise rates, they're going to break something, and the response is going to be what? See, even here, so in all these times, like when these inversions occur, you line them up and you can see that. And that's why this other tool, dynamic yield curve, shows that. You can just look, and when that inversion occurs, there's a market correction, which is 50%. These have been in the range of 50%. On S&P, depending on what sub-market you were in, it was much more. So like, tech stuff in 2000, back here in 2000, tech stuff was like 70% loss, et cetera. So that's all I wanted to point out. So I'm just trying to learn for myself and trying to compare. If I look at history, the Fed starts raising rates if they get to that point. See, okay, so now we have to talk about what's changed now. Okay, we have to talk about what's changed now. If you look here, we did get this inversion. And then the market here, we did have this really quick crash here. This is like minus 30%, depending what index you're looking at, right? Something like that. But it was really quick, and they just poured money into everything. That's the new response. Now, you did get the inversion, because once again here, you can see the 3-month and the Fed's funds rates and the 1-year yields are higher than at 30. But it's it was very quick. And then what happened is the market recovered because they just poured all the money they could pour into it. And the market just immediately recovered, broke out to all-time highs. So now the question is, what's going to happen here? And this gets very difficult because the assumption would be look, the Fed's got to raise rates. We know that. All other things being considered, what is the 10-year going to do? Let's just take it from all these other periods of time. 10-year didn't respond too much. Sometimes it did, sometimes it responds, sometimes it didn't respond very much. So let's assume it doesn't respond very much. So at some point we will get the crossover, we'll get the inversion. And then the question is, what's going to happen? If the stock market does a pullback, what are they going to do? So let's say the stock market is this hunky-dory and fine, we get an inversion and it creates all this stress on things, and then we get a correction. And the Fed always, even here, right, they always do this bailing out. They drop. What happens is that the market responds and drops, and being the stock market, and then what happens is the Fed immediately starts panicking and starts dropping their rate. So they basically drop their rate to get it below. That's sort of what you see here. Oh no, market crashing, boom, they just dropped their rates. Back here in the Cerveza thing, remember they were dropping by 50%. You go back to 2001, that's hard to see here, but they basically dropped the rates of like 50 basis points all in one fell swoop. So what they do is the Fed tries to catch up. And so that's what we could expect that they would do again. The only difference is in terms of where does the stock market go when this occurs again? I don't know, because the problem is they will drop the rates and they will try to do anything they can to print money to paper over that. But the question is, can they do it again? See, the reason they're raising rates now, and I'm talking like they're raising rates, even though they maybe they won't even be able to raise any rates at all in 2022, because they'll just have to be working through the taper, and we're going to be living with this high inflation. They're not going to be able to do anything about it. If all that's the case, can they just go in if they raise the rates somewhat? And this, maybe, I don't know if they can, because look, if you said we had to raise rates and we had to tighten things up because we put too much cash out there, the 25% increase in cash year over year in 2021, that was too much. That caused too much inflation and too much pain. So we can't do that again. If that's the case, then when you have another correction here because of the rates, what are they going to do? Are they going to be able to just pour money in again? I assume that they will, because they'll just try to ignore and forget that all this happened in the first place. In other words, they're like, we created the problem. We sent all this money to people because there was pain that we caused because of our actions to the Cerveza. And as a result of that, we had high inflation. So then we had to respond to the high inflation by, getting rid of our tapering bond purchases, et cetera, and increasing rates. Oh, and that caused a crash in the market. So we can't have that. So, okay, so now we're going to send money to people, blah, blah, blah. I don't know. I mean, one of the things is because this is a financial market, maybe what they do is they go back to the 2009 thing. So maybe this kind of implodes so maybe the way it works out is this tends to implode financial markets. Maybe companies get hit and they pour money into the companies, which would be less inflationary than what they did here, pouring money into individuals that spent it. The companies here, you pour money into them, they don't like really necessarily spend it. They're kind of filling holes in balance sheets. So maybe that's what it is. Maybe there's like in electronics, like some kind of a waveform, a clock, like, oh, we do this here, we do this over here, we do this on different parts of the cycle of the clock. I don't know. Or it just gets out of control because basically if the market crashes, and because they invert the thing, they're going to have to reverse the rates and they're going to have to allow inflation run hot. Will the Fed even be able to raise rates? I mean, it quite literally, because there's an equation here. Let me say it this way. There's some kind of equation to say, because you're at the same time that all this has been occurring, we have this increase in bond purchases. And this must correlate to like a rate. And so the fact that even if they leave this interest rate, the Fed's funds rate at 0%, and they start tapering off the bond purchases, and this would be your bond purchases, your bond purchase here, right? So if I'm guessing that this has an implied increase in rates without increasing the rates. In other words, the Fed could leave this at 0, but the fact that they're reducing their bond purchases to the point where maybe they don't, that's an effective increase in the Fed funds rate. That's what could happen. So in other words, 2 years from now, we're looking at this data. We're like, well, what happened here? The Fed actually never got to increasing. This never happened. And the question is, well, but this happened. And this effectively had a similar effect. And that's what it could be. And because we are in different times, the amount of money that they've done in QE at where we're at and the amount of the purchases, the balance sheet, that we've never seen that in history. So you cannot compare that to this period of time in 2007, back here in 2000, and all the other parts we can look on the chart, you cannot compare it to that because they never held this much assets. They never did this much quantitative easing. So that's the one got you. And all other things being equal, I would be prepared for this tapering to cause some issue before we get a chance to actually increase the rates. That is it for this one. Thanks for stopping by. Later.